All right, let's jump straight into this explainer, because today we are tackling one of the absolute biggest myths about money. If you ask most people why they aren't rich, they'll instantly point to their paycheck. They'll claim they just don't make enough income. But as we're going to see today, income alone, it literally never builds wealth. A massive salary absolutely does not equal massive wealth. Mindset is the real separator here. So today, we're pulling back the curtain to break down the hidden architecture of wealth mastery, and we're going to reveal the one critical brain shift that actually separates the truly wealthy from, well, everyone else.
So let me ask you this. Why is it that high-earning professionals, corporate earners who are bringing in thousands and thousands every single month, still find themselves living paycheck to paycheck? Well, the harsh reality is that a salary has a hard limit. When you rely solely on a paycheck, you are basically trading your finite time for money, and time is strictly limited. You only get 24 hours in a day, and no amount of grinding or hard work can magically scale time. A salary is perfectly designed to keep you comfortable, sure, but the pure mathematics of it mean it will never on its own make you wealthy. To really get this, consider a tale of two paths. Picture two colleagues. Let's call them Sarah and John. They bring home the exact same paycheck every single month down to the dollar. Sarah represents the consumer. The absolute second that money hits her checking account, she spends it instantly on lifestyle upgrades and depreciating items. John, on the other hand, is the owner. He patiently uses a portion of that exact same paycheck to build and acquire assets. Fast forward a few decades, and their lives have completely diverged. Why? Because your financial decisions, and not just your raw income, dictate your future.
Okay, so to really understand why the consumer gets stuck in that trap, we have to look at three incredibly subtle psychological traps that quietly ruin your potential for wealth. First up is lifestyle inflation. This is that dangerous habit where every single time you earn a raise, your spending immediately shoots right up with it. Maybe you go buy a luxury car or finance a much bigger house, meaning you never actually get ahead. Second is social comparison. That's buying status items purely to impress others, people you probably don't even like anyway, right? And third is instant gratification, choosing short-term comfort today over massive financial growth tomorrow.
And that brings us to the absolute core of today's explainer, the single brain shift that creates massive wealth. It requires literally rewiring how you view a dollar. Think of it like a split brain. On the left side of the spectrum, you have this chaotic, emotionally driven spending. But on the right side, you have structured, growing investments. This is the ultimate shift. It's the profound realization that money isn't just meant to be spent the second you get it. Instead, the wealthy treat cash as a tool. They use it to build systems that prioritize their long-term freedom. Simply put, they think like owners, not consumers.
Now, what's really interesting about this slide is how it redefines the entire game you are playing. If you're going to think like an owner, you've got to know what to actually own. So here's the true, real-world definition of an asset. An asset isn't just something valuable. It is an automated cash stream. It's a system, like stock market equity, rental real estate, or a scalable business, that works without your physical presence. It literally makes money while you sleep, shifting your entire life from manual effort to massive leverage.
Let's put this into perspective by comparing real wealth to fake wealth. Average earners often use debt terribly. They acquire bad debt. Those luxury cars that drop 20% in value the literal second you drive them off the dealership lot, flashy gadgets, or silent expenses like unused subscriptions that just leak out of your bank account month after month. The truly wealthy, they build their money machines first. They use capital, and yes, sometimes even good debt, to acquire stock equity and cash-flowing real estate. They know for a fact that depreciating steel blocks growth, while assets compound.
Section 2. Breaking the Survival Cycle. Subtitle: Smart Systems Beat Raw Discipline. Let's move right along.
You see, understanding assets is fantastic theory, but let's be honest, human willpower is highly unreliable. If you're just relying on sheer discipline and strict budgets to stop spending, you're eventually going to fail the moment stress hits. Instead, you need automated rules that silently build your wealth in the background. So here is one of the simplest systems you can implement right now, the 48-hour rule. Remember those psychological traps we talked about earlier? Most consumer spending is highly emotional. You see something online, and it feels urgently necessary right in that exact moment. This rule forces a pause. If an item is non-essential, you wait exactly 48 hours. During those 2 days, the emotional high totally fades, and your logical thinking returns. You'll usually find you completely forgot about the item, literally saving yourself thousands of dollars over time from all those repeated micro-losses.
Now, beyond just the 48-hour rule, your overall financial plan shouldn't require some massive, terribly complicated spreadsheet. Complexity just stops action. It really comes down to a super simple one-page plan. Step 1, write out your clear goals. Step 2, list your exact income streams. Step 3, map your exact expenses so you can find those hidden leaks. And Step 4, schedule automatic investments. Boom! This level of simple clarity completely removes the guesswork and guides your daily decisions effortlessly, because execution always beats a perfect, complex plan.
And this brilliantly illustrates exactly what that looks like in practice. The wealthy absolutely do not test their willpower every time they get paid. They set up a system exactly once. When your paycheck arrives, it should automatically divide up into specific slices. A percentage is immediately diverted to savings, another slice goes to investments, and a portion covers your automatic bill payments. What is left over in that final slice is your spendable cash. You get to enjoy total, guilt-free spending because all the heavy lifting was done automatically behind the scenes.
And right here is the absolute golden rule that powers that entire automated system. Pay yourself first. Average earners do the exact opposite. They pay their bills, they spend on their lifestyle, and then they cross their fingers and try to save whatever remnants are left over. And usually, there's absolutely nothing left. The lazy, totally foolproof way to guarantee wealth is to reverse that financial flow. Pay your investments first. Remove the daily temptation entirely by letting your system do the saving before you even see the money in your account. Section 3. The Power of Boring Consistency. Subtitle: Play the Long Game.
Let's move to and see how this builds, because you've shifted your mindset, you've set up your automated systems, but now you face the absolute hardest part: waiting. Building wealth feels deceptively slow at the beginning. Honestly, it's why so many people quit their investment plans early and chase those silly get-rich-quick traps instead. But boring consistency always outperforms spectacular short-lived intensity. Real wealth is built on what we call the decade trick. Very few people actually think in decades, most think in single days, letting daily stock market noise or fleeting internet trends ruin their strategy. But look at this progression. In one day, you use the 48-hour rule to ignore an emotional purchase. In 1 month, you've successfully automated your savings. In 1 year, you've built up a full emergency fund. And in 10 years, that is when the compounding explosion happens. Adopting a long-term perspective deletes the noise and literally makes your financial growth mathematically inevitable.
That compounding explosion is powered by the snowball effect. You see, you do not need millions to start, you just need to start. Even investing a tiny amount weekly, like $5 or $10, builds serious momentum. Because your returns earn more returns, the growth doesn't just stay flat and linear, it eventually explodes vertically. Pure, uninterrupted time is your ultimate leverage. Starting early with small amounts will always, without fail, beat starting late with big amounts.
So I want to leave you with one final, really important question to think about. Are your daily habits right now funding your long-term freedom or just your temporary comfort? Remember, every single spending decision you make is a trade. You aren't just trading cash. You are actively trading your future financial options. We've seen today that closing that identity gap, shifting from a consumer who constantly seeks instant gratification to an owner who patiently builds automated assets, is the true secret to wealth. So take a hard look at your systems today and decide right now which path you are going to walk.